In just the past few weeks, we've seen a number of different banks come out and report the latest earnings, the latest profit figures, and then their predictions of where the economy is going. And the common trend amongst most big banks, not all of them, but most big banks, is that profits have been soaring because, let me just read it to you, because they've been seeing increases in lending and credit card transactions. But it's not just the fact that they've been seeing more lending and more borrowing happen, but the fact that this borrowings happen at significantly higher interest rates, because now when you swipe money on your credit card that you don't have, the interest rate on your credit card is significantly higher. When you go out and you borrow $500,000 from a mortgage, your interest rate is a lot higher. That means the bank is making more money in interest, which can help drive up profits so long as people are borrowing money. And right now, people are still borrowing money. Now, all of this so far is the obvious part, but the part that's even more interesting isn't just the profits that banks are making right now, but rather what banks are predicting about the economy coming in the future, because that's been signaling some interesting pressures ahead in our economy. And the way that I want to do that is by going directly to the source, meaning directly to the banks and seeing what the banks have said instead of listening to the media's coverage or what the banks said. That way we can get a better idea of the bank's predictions of what's coming in the economy. And I want to take a look at JP Morgan Chase Bank's press release that they put out when they released their earnings statement. Now, just so you know, if you want to read the press release for yourself, I've also linked it for you down in the description. And then secondly, on August 15th, that is going to be the 52nd anniversary of the dollar being taken off of the gold standard. And because of that, I am going to be hosting my first investor summit. This is going to be a completely free virtual summit where I'm going to be talking about how our economy's changed, but even more than that, how you can capitalize on new investment opportunities in this new economy. We've seen a ton of changes, from inflation to interest rates to our dollar, with everything going on, not just in our economy, but the global economy. And so in this investor summit, I'm going to be going over how our economy has changed, but more importantly, how you can capitalize on this opportunity. This is my first time doing it. It's completely free. So if you want to register for this investor summit, well, we still have seats because the seats are limited. There's a limited number of people that can actually join because of our software. So if you want to check it out and you want to join, I would love for you to be there. I got the link for you down in the description below. Jamie Dimon is the CEO of JP Morgan Chase Bank. And in the press release by JP Morgan Chase Bank, Jamie Dimon put out his own statement about what he feels is going on in the company and what might be coming in the economy ahead. So let's take a look at that. He starts off by saying that we have seen another quarter of strong results with huge profits and growth across the entire business. But then a little bit later in his statement, you start to see a few words of caution about what might be coming next, because the company is doing great today, but he's also taken it with a grain of salt. The United States economy continues to be resilient. Consumer balance sheets remain healthy, and consumers are spending, albeit a little bit more slowly. Labor markets have softened somewhat, but the job market remains strong. That being said, there are still some salient risks in the immediate view, many of which I have written about in the past year. The reason why it's interesting is because he says that consumers are still spending, but it's slowing down. The job market is strong, but it's softening a little bit. And then he says that there are risks in the economy that he's been talking about. Now, what are these risks that he's been talking about? Well, consumer spending. See, the interesting thing about consumer spending is that consumer spending is good for the economy, especially in the short term, but it's bad for the consumer. Just take a look at what Jamie Dimon said when an analyst asked him about that. The consumer is in good shape, says Jamie Dimon. They're spending down their excess cash. See, our economy is based on spending. The more money you spend, the richer somebody else gets, period. If you don't spend your money, that's not good for the economy. It might be good for you because now you can save your money, you can pay down your debts, you can start investing your money, but it's not so good for the growth of the economy because that means now Chipotle, Sweetgreen, Lululemon, Apple are not making money because you refuse to spend your money or because you have no more money to spend. What we've been seeing happen recently is that savings balances have been falling because people are digging into their savings to fund their regular expenses. And in addition to that, credit card balances have been rising because, again, people are using the credit card to fund their daily expenses. So the economy is booming because people are spending. But people aren't just spending their incomes, they're having to spend their savings and they're having to spend their credit cards. Because now when you spend and the economy is booming based off of people's incomes, no big deal. But when people have to go beyond their means in order to spend, and that's why the economy is booming, well, there's a lifespan with that. Because there's only so much debt that people can go into. And there's only so deep that people can go into their savings before they run out. And that's kind of the double-edged sword of consumer spending, where yeah, consumer is strong. People are spending like crazy. They're spending down their savings. But then what happens when the savings get spent? And that's the double-edged sword that Jamie Dimon is saying, that there's still some risks ahead. Consumers are slowly using up their cash buffers. Core inflation has been stubbornly high, increasing the risk that interest rates can go up higher and stay higher for longer. Quantitative tightening of this scale has never occurred. Fiscal deficits are large. And then you have the war in Ukraine that's still going on. There's a lot to unpack with that one. I already talked about now how consumer spending is going up because people are digging into their savings, but there's only so much that people can dig into their savings. The second thing that he talks about is inflation and interest rates and how they go hand in hand. Number one, that core inflation is still so high, and that's the reason why we could be seeing higher interest rates in the future. Now, the interesting thing about this is if you've been paying attention to what's been going on in the financial media, or if you've been reading this in market briefs, that CPI has fallen from its highs of 9 point some percent all the way down to 3%. This has been the headline of inflation for the past little while, that inflation is coming down. But what's interesting is that Jamie Dimon said core inflation is still so high. Core inflation is a different measure of inflation, and core inflation is what the Federal Reserve Bank looks at when they make the decision of what they want to do with interest rates. And now if we take a look at core inflation has fallen all the way down to 4.8% from its high of 6.5%. So core inflation has fallen, but it hasn't fallen as drastically as CPI. Core inflation is what Jamie Dimon is talking about. Core inflation is what the Federal Reserve Bank is talking about. Core inflation is much more stubborn and more difficult to bring down. And this is where Jamie Dimon is saying that we could still see higher interest rates. Then, to couple that, Jamie Dimon talks about the effect of all this quantitative tightening that we haven't seen this rapidly ever. What is quantitative tightening? It's the opposite of quantitative easing. What is quantitative easing? Quantitative easing is money printing. That's what we saw happen in 2020 and 2021. The Fed opened up the money printer and they cut interest rates to stimulate the economy. Well, the side effect of all the quantitative easing was the inflation that we have been seeing and are still seeing. Now, to combat the inflation, the Federal Reserve Bank has to do quantitative tightening. What's quantitative tightening? Well, now raising interest rates, and instead of printing money and putting it into the economy, they're trying to pull money out of the economy by selling off some of their balance sheet. Now, these higher interest rates have an effect. And Jamie Dimon is saying that we haven't seen the full effect of this quantitative tightening. We haven't seen the full effect of the higher interest rates, while interest rates could potentially even go higher from here. And then he briefly talks about the national deficit. The national deficit means the government makes an X amount of dollars in tax revenue, and then they spend a whole bunch more than that because they have higher expenses. Well, the national debt here in the United States just passed $32 trillion. There's a cost to this, and the cost is, well, the government has to pay this money back plus interest. Well, the difference between now and a couple of years ago is that a couple of years ago, interest rates were so low. And so now when the government has to pay this money back, because yes, the government has to pay that money back plus interest, now the government's payments are rising. They're rising not just because the debt levels are rising, but because interest rates also adjust. The government doesn't have a 30-year fixed rate mortgage. Their interest rates also readjust. And so now in the coming months and years, as more and more of the national debt readjusts, the interest payments for the government will also rise. Now, the interesting thing is, how does the government get their money? Well, they get their money from you and me and everybody else, taxpayers, through tax dollars. So that means more and more tax dollars are going to have to be used to pay down the debt instead of being used to build bridges and hire firefighters and police officers and teachers and actually improve the investments into the country. That's a concern, because that means, well, how is the government going to continue funding all their operations? They might have to print more money. That could cause more economic issues because, well, more money printing, more inflation at a time when there already is high inflation. You can start to see the concerns with that. And then Jamie Dimon tops it off by talking about the war in Ukraine and the potential geopolitical issues that are going on with that. Now, I'm not a geopolitical expert, but the war in Ukraine, if that expands, can cause more issues. Not to mention the fact that even if it doesn't expand, the war in Ukraine is a money pit financially for the United States. Now, of course, there's devastating life losses, which are unquantifiable, but from the United States perspective, the United States is spending billions and billions of dollars helping fund Ukraine. there's a cost to that. There's a cost to taxpayers for that. So all these things coupled together are the red flags that Jamie Dimon is saying is that, yeah, consumers are spending money. That's causing the economy to boom, and that's causing our profits to boom because we're getting more interest payments. However, the spending is slowing down. Why is spending slowing down? Because the savings are dwindling. Credit card debts are reaching their peaks. They haven't hit there yet. But if that were to happen, that could cause a real slowdown in the economy. And that's the concerns that Jamie Dimon is talking about. So what does all this mean for you? Well, number one, this is why you need to get financially educated. This is why you need to get prepared. And then number three, this is why you should be paying attention to what's happening. That way you can understand what's happening instead of getting blindsided. And that's why I created Market Briefs as a free resource to help you stay up to date on what's happening when it's happening. Americans are spending more money than ever before, even if they don't have the money to spend. And this is a sign of how strong our economy is. At least that's according to economists who say that not even a recession can hurt our spending here in America. And what this article says is that there are three main factors which are contributing to the growth